Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
I was going to ask you, did you forget what this was?
Well,
yeah, there was a pause there.
I forgot to go into Do Not Disturb, so something popped up here. I was kind of still giggling at the fact that I hit record and you were kind of mumbling as the countdown was going on. There's something that you said that ended up in the recording, and I'm kind of wondering if I'm just going to leave it in there.
You probably will. Because not on purpose, you'll probably just forget. People think we go through some really high stakes, long editing process here. I get solicitations from people all the time saying, we can edit your podcast. We have this company that does this and we can remove that burden from you. I'm like, if only you know the little burden it was.
We've been doing this a long time. It's not that big a burden.
I go through and make sure the volume levels are, somewhat equal.
Mm-hmm.
And convert it to an MP3 file, and that's pretty much
here. You have it, the Insurance Pro Blog Podcast.
In a nutshell.
Talking about audio editing and a degree that you never ever wanted to know. We're just trying to scare the next generation of agents that thinks they're going to come out and, and rival us away. Oh, that sounds complicated.
We're going to scare the competition.
Yeah, we're really not. Just so you know.
No, you're more than welcome to start a podcast that no one listens to.
So
you too can have an audience of tens. It'd probably be the same 10 that listen to ours.
This is true. This is true.
All right. So
today we're here to talk about the stuff no one ever talks about. The things we as agents forget to mention when it comes to whole life insurance.
But probably should talk about, right?
We should absolutely discuss them. So,
yeah. Mm-hmm.
As a layperson trying to sort things out, these are details that are important. They're somewhat tucked into the background, but they matter a lot when it comes to fundamental understanding of mechanics and such. Because if you ignore these things, you're going to head down the road of potentially making a mistake, an assumption that doesn't hold true, learning something that you wished you'd known. Some of them are more kind of deal breaking than others, I would say.
Yep.
So that's just something to note.
Some of them are sort of calibrating your expectations.
Yeah.
Because I think, we've talked to quite a few people over the years that are kind of disappointed with the policy that they bought, not from us, but from someone. And they're some years into it and they're not pleased with how some particular something is working out. And we sort of point out to them, well, it was never going to work out that way. So. Right.
Because there's something that was baked in assumption wise that just, that's not that way this works.
Right. And usually that's just a misunderstanding. So.
That is correct. That is very correct. So first on the list speaks very explicitly to something that a lot of people look at whole life insurance for when it comes to cash accumulation. And that is the income. In particular, the way that income gets projected in what we call the illustration. That's the ledger with all the numbers for your whole life insurance proposal.
Okay.
So there are assumptions that get made, and there are things that we are basically, there are things that we have to assume we know when it comes to the income projection that are impossible to know in real life.
Yes.
So
why do we do them then?
We know what the start date is for most people. We're going to start our income at this point. But what we're also assuming is that
we know when they say they want to start their income.
Yeah. But even practically, like if you were to call us up and say, hey, the day has come, I'm retired, I want to start taking income from my whole life policy, we know when the start date is.
Yes.
But when we do these income projections, we also happen to know when the end date is.
True.
Which, that's a mighty difficult thing to estimate for somebody in real life.
Yeah.
Unless they are fundamentally, and I would say unrelentingly, of the opinion that I am going to take X amount of dollars out of this whole life policy for the next, let's say, 15 years, and that's what I'm going to do, and then I'm going to stop, and that's A-okay.
Right. We've had
if that is your situation, you fall into a smaller crowd of people than listen to this podcast, and good for you. But that's not how most people are going to approach this.
Right.
The other thing that we are assuming we know is the dividend interest rate in all the years.
Right. Mm-hmm.
Which we do not.
We absolutely do not. The insurance company doesn't either.
No.
No one knows.
Nobody knows. So this puts us in a situation where we have to strategically think through what could possibly go differently from today and what kind of contingencies we can build into the income plan to absorb that reality, things not going quite the way we thought.
Uh-huh.
Because if that takes place, then we don't have to make adjustments to the income plan that's coming out of the whole life policy.
Right.
So the easiest, simplest, sort of zoomed out way that we have accomplished that here at the Insurance Pro Blog is simply to look at the cash value that is in the whole life policy in the year that we begin the income and take 5% as the withdrawal number from that initial amount. And that's pretty much been a solid number to rely on as the sustainable continued income.
Right. So you think there's some margin of safety in that assumption? I
do.
Okay.
I do. Because most whole life illustrations will assume a higher income than that. When we plug in
5% of the cash value.
Correct. So when we have the option to go in and basically ask the software to solve. So based on what's going on here, solve the highest amount of income that we can extract from this policy from this date to that date. And it'll do it. And going out to like age 100, usually that number comes out to something a little higher than 5%.
Right.
So using 5% works out quite well. It also happens to be the long-term average of where dividend scales tend to rest. Usually that's where loan rates have tended to have a lot of gravity around as well. So 5% is a number that has a lot of historical data behind it saying we don't feel this is outside the range of reasonableness.
Right. Yep. Okay.
Now, practically speaking, as an aside, we don't always meet that many people who decide systematically this is what I'm going to take and I'm going to take it every year regardless. Because income needs to fluctuate in retirement. Yes. And some people might decide, well, I don't need all of the money that this tells me I can take. So if I've got $1 million of cash value, 5% would be $50,000 coming out of the policy. You might decide, I only need 30. That's fine. You could take 30.
Yep. That is very true.
Yeah, go ahead.
No, I was just going to say the industry likes to run these sort of static income illustrations, and I honestly feel like we probably did them more in years past. We don't do them as much anymore. No. And not to say that we wouldn't do them for someone, but in our experience, that's just not how people use them. Not really.
Right. When it comes to income, they can be a little more varied.
Yeah.
With respect to the income that they pull from whole life insurance. That's just been the observation.
Yep.
The other thing that's important here, if we assume the income too high, and you actually do that, you could find yourself in a situation years down the road that your income amount puts you in a place where you're at risk of the loan balance exceeding the cash value in the policy. And in that situation,
not a good thing.
You would need to put money back into the policy. And if you don't, it'll lapse. And if that happens, that creates a very ugly tax consequence that you do not want as a reality. So the tax-free nature of life insurance works, but we have to approach the process of using it for income with a bit of prudence. It's not super easy to create this problem, but it's not impossible. And that's the important piece.
Okay. Yep.
Next on our list.
I was about to say we got 8, so we better hustle.
Not all of them are going to take that much time. Paid up addition flexibility. Paid up addition flexibility is great right up until it's not.
Yeah.
Paid up additions are great things. And they are the way that we often talk about the payment going to whole life insurance being flexible. But there are limitations to that, and there are rules regarding the flexibility of paid up additions that you must understand. And you cannot assume that because it works this way with that company, it's going to work the same way everywhere else.
I was going to say, this is the confusing part, is they're all different. Mm-hmm. And even sometimes they change the terms from policy to policy as you go through years. So I'm not saying they changed the flexibility of a PUA rider on an existing policy, but they could stop writing this policy and start writing a new policy.
Yeah.
And
that doesn't affect somebody who owns that policy.
No, I'm just saying for us.
Yes, it's frustrating.
It's like, wait a minute, which one is that?
Yes.
Well, that has a different rule. So,
I can think of one company in particular that there have been like 4 different iterations of whole life insurance since you and I have been working together. We have sold practically all 4 of them, and so when somebody asks about the rules regarding their paid up edition, we have to first remember which one it is they own, and then second remember what the rules are for that specific product.
Yeah, if I remember, I just go look them up.
Yes.
I usually pull up the their signed illustration because it's in there.
Mm-hmm.
It spells out the PUA rider policy. So,
but you should know that in general, there are 2 broad types of paid up edition rider, flexible and level. The level ones do have some degree of flexibility, but it's not.
just to confuse matters.
Yes. But it's not nearly as flexible as the flexible one, and they're not universally available at every company.
Right.
So, just because one company has a flexible paid up edition rider doesn't mean the other one that you're looking at does. So it's something to bear in mind, because if you think you have a flexible paid up edition rider and you do not, and you make an adjustment to the amount going towards that rider, you may permanently decrease the amount of money you can put in your whole life policy.
That's right. Yep. Absolutely true.
That's something to be aware of. The last thing I'll mention is there are a very limited number of companies that do have flexible paid up edition riders, but the allowable flexibility changes after time.
Yeah, there's a limit to the flexibility, and there's a time period on what that limit entails.
Yep, that might look something like there's always going to be some ratio relative to the base whole life premium with everybody, flexible or level. But that might look something like for the first 10 years, you're allowed to do 10 times whatever the base whole life premium is. And then starting in year 11, 1 times. That's it. Unless you ask us and we approve it, we'll let you put more in. But barring that situation, that's it. And oddly enough, there's even one company that has that rule, but its illustrations will just assume that the company automatically granted that approval each and every single year that they illustrate more paid up editions going into the policy for some very bizarre reason. So they're important rules to understand.
Gotcha.
When it comes to consequences for paid up editions. Next on the list is probably one of my favorite sacred cows.
All righty.
The waiver of premium rider is not that great. Now, I'm an insurance agent.
You're going to put that in context, because I feel like you are.
I'm an insurance agent. I started my illustrious insurance career at the Guardian Life Insurance Company of America, which had already acquired the Berkshire Life Insurance Company of America at that point. Which means I was taught from day one that disability insurance, individual disability insurance, is the single most important financial financial tool you can buy.
Right.
And look, for a number of people who are highly skilled and highly paid, I believe that is extremely true.
Mm-hmm.
And I think there are lots of great things that can be advocated for when it comes to owning disability insurance. You might make an assumption from that means that I think waiver premium is on par with that and super, super special. That's where it breaks down, because the waiver of premium rider is quite bad in terms of how it defines disability. And also,
why don't you tell us what it does first?
Yep, we'll do that.
At least in theory.
Yep, and quite bad in terms of what it covers. So the waiver of premium is basically a disability policy that's attached to your life insurance policy that promises to pay the premium that's due in the event you become disabled.
It's a very limited scope of disability.
Correct.
In that it pays the life insurance premium if you're disabled.
Yes. So if you buy a whole life policy with a $5,000 a year premium and you have the waiver of premium rider and you become disabled, you're unable to do what you're doing for work because of sickness or illness, you have the ability to trigger this rider and it will pay that $5,000 premium for you.
Right.
Assuming that that's a regular whole life policy.
Right.
The breakdown for me with waiver of premium one, it's not cheap. So like the per dollar that you get with respect to what it's paying for the premium relative to what you pay for the rider, it's pricey. The definition of disability is not great. So what I mean by that is when it comes to disability insurance, we fuss a lot about how disability gets defined. there are two broad categories. We have the category that says you are eligible for the benefit if you lose the ability to do very specifically what you do, regardless of your ability to do anything else. The general term for that is what we call own occupation. The other definition says that you are eligible for benefit if you lose the ability to do what you're doing, but also the ability to do basically anything else.
Mm-hmm.
We call that any occupation. Obviously, the ability to be qualified for benefits, if you can't do your specific job, but you can do any other job, is a whole lot better than the other one.
Right.
And most waiver of premium riders offer a modified version of that says, yes, you're eligible if you can't do specifically what you do, but it comes with the provision that you have to choose not to do anything else.
Right.
And that definition of disability only lasts for somewhere between 2 to 6 years once the disability begins. After that 2 to 6 year period, the definition changes to that far less favorable version. So if you are in a situation where you can't do specifically what you can do, but you can do something else, you just choose not to, so that you qualify for the definition of disability under the waiver premium rider, you will get whatever the period is, 2 to 6 years of benefit from that. But once that expires, guess what? You got to go back to work. Otherwise, we're not going to pay your premium for you.
Or you got to prove that you're totally disabled and you can't do anything at all.
Correct. If it sounds confusing, that's because it is, and it's just not that special. The other piece that makes it disappointing is that for most whole life products, it will not cover the paid up additions rider.
Right.
And that is a big, big problem when it comes to somebody who's focused on a cash accumulation of life insurance purchase.
Yep.
I should be clear that that's unique to whole life insurance. There are definitely universal life insurance options where you can cover the excess amount that's going in there. Now, for the limited number of whole life products that are out there that will cover the paid up additions rider under the waiver of premium rider, it will only cover the amount of paid up additions that are paid at issue. That is very, very important to understand. That company that I referenced earlier that I used to work for when I started my career is one of the companies that will cover it. But if you buy your whole life policy with a little tiny paid up additions rider to start out with, and then with a plan to fund it a whole lot more later, you won't have any coverage from the waiver premium rider on that paid up additions rider. And I can't tell you the number of times I saw agents put policies in force that way and scratched my head.
What about term riders?
What do you mean?
On all life policy, are they covered by the waiver premium?
That depends on the whole life
like
policy.
Flexible term rider.
Yeah, some do, some don't. Yep.
Yeah.
So again, a deficiency potentially of the rider.
Yep. None of these are us telling you not to do something. They're just be aware of how it works.
Yes. Assess
know
the
what
situation.
you're paying for.
Decide if the expense of it makes sense. And I think a lot of people are going to come down on, probably not worth having. The next one, reducing the death benefit can improve your performance. We don't talk about reducing the death benefit on a whole life hardly ever at all, but it can be done. Probably the reason we don't talk about it is because there are some strict rules we have to follow when we do it.
Right.
And if you make a mistake, that can have bad consequences. So, very fundamentally, when you buy a life insurance policy, cash value life insurance policy for the sake of cash, the cash accumulation side, the death benefit that you have in general is only the amount that you're going to need in order to pay the amount that you're planning to pay into the policy. So if you're planning to put $50,000 a year into the policy, we need the death benefit that is sufficient to allow $50,000 a year to go into the policy.
Right.
If after some period of time you decide you no longer want to put $50,000 into the policy, but you'd like to put some number less than that into the policy, you now have more death benefit than you need. Which means we could, under certain circumstances, make a reduction to the death benefit to further enhance the performance of cash value because we'll be eliminating some expenses that are tied to the policy because of the larger death benefit. Something that we can and have done for whole life policies. But there are some rules we have to follow regarding that. The big one being that death benefit reductions within the first 15 years can create a problem with a forced taxed recognition of money coming out of the policy if we make a reduction that's too aggressive.
Right.
So we may look at the policy and decide, hey, we're going to reduce the death benefit by X amount, and we find out that, oops, that was too much because of the amount of money that they continue to put into the policy. And we've run into that situation, let's say in year 13.
Mm-hmm.
The good news is all we have to do is take money out of the policy to avoid the problem of failing the life insurance qualification test. The bad news is that will not be a first in, first out distribution. It'll be a last in, first out distribution, which means if there's gain in the policy, and there should be if it's a cash rich policy, it'll all be taxed as ordinary income.
Right.
So that's one of the things we need to be very careful about. The other quirk when it comes to whole life insurance is that if we are going to move the policy into paid up status, the reduced paid up option, there are times that making those death benefit reductions can create MEC violations if we're trying to trigger the reduced paid up option within a certain time frame that we may not understand when we make the death benefit reduction, because there's certain things that we won't know. What the dividend will be ultimately over the next several years as they are earned, or what the premium that the individual is going to pay for the next several years. So it can be done. There are times that it's well worth doing, but it has to be approached with a certain amount of care and prudence. This is not something that you call up an inexperienced agent to take care of.
Right.
This is something you call the guys at the Insurance Pro Blog to take care of.
Yeah.
Now that I've scared you all out of whole life insurance, let me tell you about something we really like about it. Term blending's a thing, and it should absolutely be understood and done.
Yes.
When we're seeking cash policies, like using term blending to try and make the whole life premium less expensive is potentially problematic.
Yeah.
So what I mean by that is you decide you want $1 million of whole life insurance, but $1 million of whole life insurance is too expensive. So somebody says, "I'll tell you what if we do $500,000 of whole life insurance and $500,000 of term insurance tied to the whole life policy, not a separate term policy, it's just attached to it. That'll make the premium less expensive." You go, "Oh, I like it less expensive. Let's do that." It can work, but there's a lot of things that we are highly dependent on the dividend about if we do that.
Yep.
So it's much, much better.
Well, in that regard, you've kind of taken it and turned it into a universal life policy.
Yes, you have.
I mean,
you have indeed.
Academically, it's still a whole life policy. I don't want to confuse people.
Yeah. But you've brought functionality closer to universal life insurance in a way that a lot of very, very ardent whole life advocates hate.
Yeah.
Even though they do it all the time, the term blending thing. So from a trying to build this to optimize cash perspective, using a term rider can absolutely give you the death benefit that's necessary to pay the premium, the gross premium that you want to, I mentioned earlier, without, or by reducing the base whole life premium and being able to fill that back in with paid up additions. That is a very, very fantastic thing that we're allowed to do with whole life insurance.
Right.
So don't overlook it, understand it exists, and don't run away from it just because it's term insurance.
Right.
I think back to a few years ago for me, there were a couple of people that I talked to about whole life insurance who just had a anti-term life insurance bias for some reason. And it was very difficult to get them to understand, look, we're not buying term insurance for the traditional sake of term insurance. We're doing it as a mechanism to get this to be a cash-rich thing. But that word term was something that caused a lot of resistance.
Right.
Don't do that.
It's got to be there if you want to maximize your cash value. Gross.
Yes, it does. Yes, it does. You are not going to get the best of cash accumulation design if you do not have a term blend. It's not going to happen.
Right.
Number 6 on the list. Dividends have a very strong likelihood to decline with age. And this is something that often gets ignored when it comes to illustrations. And it's not well understood, and we don't talk about it near enough.
Yep.
So as you age.
It didn't appear all that much when we were in a period where dividend rates went up year after year after year.
Because there was an offset that was created by investment profits relative to mortality expense assumptions.
Yeah. Yep.
But
when we went through that long period of super low interest rates in the, what do we call it? The 2010s now? Or is that what we call it?
20 teens.
The tens and the teens.
Yeah. Ooh, I like that. The 10s and the teens. Let's go with that.
Some things appeared.
And what
that people
appeared is the
hadn't seen
fact,
before.
yeah, what appeared is the fact that as you get older, the risk of you dying goes up exponentially.
What a concept, right?
That risk has an expense associated with it that is going to be assumed in every whole life insurance pricing structure.
Yep.
And that becomes...
And in the dividend. That
becomes a negative adjustment to the payable dividend.
Yeah.
That's just how that works. So if you are 90, the mortality expense assumption that is going to deduct from the payable dividend to your policy is going to be quite large.
Yep. And when the net investment returns haven't been there, then the adjustment is becomes much more evident.
It does. And relative and absolute plays a role here. So for a thinly funded policy that was put into a dividend option status years ago to use the dividend to pay the premium,
yep,
there's far more risk that you're going to very, very blatantly see the reduction in dividend because of this reality. For those who are max funding whole life insurance with lots of cash there, even though the relative nature is still taking place, the absolute growth of the investment component of that policy is overwhelming that reduction because of mortality.
Yes.
So it's harder to pick that out in that case.
Yep.
So the
I was going to say, and I think in every case you and I have seen this happen, it was that first instance you mentioned. It was people had been offsetting their premium with dividend for a number of years.
And it becomes even more problematic, or it becomes not problematic. It becomes more likely and more of a reality for people who use their dividend to pay the premium and they take the excess amount. So whatever dividend is left over after paying the premium as cash.
Right.
Because at that point, there's no additional money going into the whole life policy that doesn't grow the payable dividend that's attributable to investment performance on the whole life policy.
Yep.
So for an individual who put their policy into that kind of dividend status, they change the dividend option to pay the premium. Then they just take the remainder as a cash check each year and go do whatever they want to with it. They may discover that as they get more advanced in age, all of a sudden the dividend will not cover the premium anymore.
Yep.
That's not the insurance company trying to get away with something. That's not some sort of evil element of gotcha whole life insurance. That's just pure functionality of the fact that you are getting to a point where the expense of insuring you is so much that it is reducing the dividend by an amount substantial enough to no longer cover the premium. That's functionally how whole life insurance works.
Yep. Number 7.
The penultimate one. 10 pay and shorter pay whole life policies are not the bee's knees.
What?
I know. So I remember when I was very new to the life insurance industry, I got this little pamphlet that had the life insurance products that the company issued. And it had these little like charts that kind of showed you sort of their key attributes. And one of the major call outs was the shorter the guaranteed payment period of the policy, the better the cash accumulation is at your 15, 20, 25, 30, et cetera.
Right.
The insinuation from that was if your client is looking for the highest rate of return on cash value, they should buy the shorter guaranteed payment period product.
Right.
Which in a very, very, very basic world of none of the cool fancy things we can do to modify how whole life insurance works, that is true. But practically speaking, it's not
you're just
very
putting
useful.
more money in on the front end to compound.
Yep.
So, I mean, at a very basic level, that is true.
But there's a whole universe of things we can do with whole life insurance that open up way more growth opportunity than that.
Yeah.
So 10 pay is fine from the standpoint that it can guarantee that after 10 payments, the policy is paid up and the initial death benefit that you chose is guaranteed.
Yep.
We can't take that away.
And some people like that. And some people want that.
That is something that 10 pay has, and that is what it can offer.
Yep.
But as we have mentioned a few times in the past on this very podcast, guarantees have a cost. And sometimes you can accomplish practically the same thing without incurring that cost. So it's possible to purchase a non-10 pay whole life product, something that's paid up, let's say at age 100, and pay the difference between the 10 pay premium and that paid up at 100 product with paid up additions, for example. And you may find that after 10 years, even if you go into the reduced paid up status of the policy, you have more death benefit than you'd have with the 10 pay policy.
Yep.
That's not guaranteed.
No.
That is a result that is dependent on, one, you paying the paid up additions, and two, dividends being earned on the policy. So we cannot guarantee that. But we can assess the likelihood that this works out better than 10 pay and then make a decision from there. Do we want 10 pay or do we want the other approach?
Right.
That's the approach that we should be taking when it comes to this.
Can I bring up something here as well?
You can.
Because one of the things is we've had some people sort of do what we've had some clients do what you're talking about. Whereas they didn't buy a true 10 pay, but they used something like a 10 pay structure with a policy that was paid to 100 or 121 or whatever it was, right? And one of the things that's good about doing that versus a true 10 pay in some cases is that many times people get to the end of the period that they were planning to pay and they decided they want to pay more.
Yep.
Because people out there are going, why would they want to do that? It's like, well, because now they actually believe what the cash value can do as opposed to just seeing it on a piece of paper.
Right.
Like when we sold it to them, all they could see was an illustration.
It was theoretical at that time.
They assumed we were telling the truth and that the insurance company's, illustration was in the realm of, I'm not saying anything's worked out perfectly like the illustration showed. Come on, let's not be ridiculous. That's not how it works. But it was in the ballpark, right? Like, yeah, everybody understands dividend rates go up and down, things change, blah, blah, blah. But it was in the realm of, the result at the end of the period, whether it was 7 years or 10 years or whatever it was for this particular person, is like in line with what it should have been based on the original illustration. And so they go, well, I still got money and I kind of like to keep doing this. So if you have that design versus a true 10 pay, in many cases, you can still have some time to pay more premiums. In some cases, you really don't have much more. It just depends on a lot of things. But chances are you're going to have a little more flexibility to continue paying versus if it's a true 10 pay, it's over. Okay, sorry. Number 8. We got to move on. We're in the bonus round already.
Well, the bonus round comes at a time where we talk about a product that's specifically designed to deal with bonuses.
I was about to say the bonus round is sponsored by
High Early Cash Value.
The number 8. Yeah.
So High Early Cash Value whole life insurance sounds like it would be the thing to the layperson.
I mean, it's got all the right words in there.
I'm buying the policy for cash, so why not buy the one that tells me it's got cash in it? That makes sense to me.
Sounds good.
The problem with High Early Cash Value is that it was never designed to be a consumer's cash builder. It was designed to...
High early means low late. No.
That's
not true. That
we need
trademark.
Give us a 5-star review, and we will send you your High Early means low late T-shirt from the Insurance Pro line.
Anyway, sorry.
Now we're going to have to print T-shirts.
Explain, sir. Explain.
Yeah. So High Early Cash Value was designed to address a very specific business planning.
It wasn't a consumer. It wasn't even offered to like individuals.
Nope, it wasn't.
At least my recollection is that it wasn't.
Not in general. There's one company that's always had a low minimum for it that kind of lets anybody buy it that wants to. But most companies reserved it as, one, you needed to have a premium that was at least 6 figures to even buy it.
Right.
And it was reserved for very specific circumstances that were business owned. And the reason for that is some businesses will create special carve out plans for certain employees, and they'll use life insurance to fund those plans. For an array of different reasons.
That is well beyond the scope of this podcast.
For an array of different reasons that we're not going to dive into because we're already in the bonus round.
Right.
The problem that they face with traditional whole life insurance is there's not a lot of cash in the beginning.
Right.
So they have this liability that is created by this benefit, but the thing that funds that liability has very little cash.
Right.
And for a business that depends on lending, they go to the bank and the bank looks at the balance sheet and says, well, you got this big liability, but there's nothing on the other side of the ledger that balances it out. We don't like that. So High Early Cash Value was designed to provide the benefits of funding that that liability and creating a much stronger cash position early on. So there wasn't quite the negative impact on the balance sheet to the business, especially from a lending perspective.
Yeah. Yeah. Because you could pay a $50,000 premium and had $49,000 of cash value in the first year or something like that.
Correct. It comes with a significant reduction in cash value performance as time goes on. Most businesses are willing to accept that because ultimately the asset that backs the liability for them in a lot of cases is the death benefit, not the cash value.
Right. Mm-hmm.
So they're not so worried about that reduction in cash value growth.
Right.
That might look realistically something like if you buy a well-designed whole life policy 30 years out, it's got like a 5-ish% rate of return, maybe 4.5%, 5%, depends on how old you are when you buy it. Higher cash value is probably going to sit more in the low 3s at best.
Right.
So a substantial reduction in the accumulation of cash value in order to have a slight bump in available cash. Now, look, I would argue all day long, even today, that for business planning, you might want to look at what we call blended whole life insurance in addition to higher cash value, because that difference in terms of early cash value may not be enough to make any difference from a lending perspective.
Right.
And you'll end up with even more cash later on. It's definitely got an argument to be considered.
Yeah.
But the one thing you do not want to make the mistake as a consumer buying whole life insurance for the sake of cash accumulation is to assume that high early cash value is the insurance company basically telling you, hey, this is the one right here.
Yeah.
No need to make it any more complicated.
I'm going to oversimplify, but it's a case of there's no free lunch with this. So there's a trade-off. If you're going to get, if the insurance company is going to reward you with a high early cash value early on in your policy life cycle, then you're giving up something long-term.
Right.
Because there's no magic in the expense structure. We've talked about this like a dozen times or more probably on this podcast. There's no magic in the expense structure of a whole life insurance policy to an insurance company.
If they're giving you something on this end, they're taking something on the other end.
It's just a difference in how they amortize the cost.
Yep. That's
all it is. It's accounting for them.
Mm-hmm.
And so they have to account for it somewhere. And that's effectively how they do it. Or at least that's my super simple, rural Georgia understanding.
And look, the same principle applies to blended whole life insurance that we talk so much about, because people might look at that and go, well, if they're willing to give me more cash value, what is it that I'm losing versus the traditional whole life insurance? And the answer is guarantees.
Right. Yeah.
We cannot guarantee the death benefit on a blended whole life policy like we can a regular whole life policy.
Thereby, it's much less expensive to the insurance company to provide that product because they don't have to provide the guarantees to the same level. Right.
But that's what you're giving up. So if you're willing to sacrifice a guaranteed death benefit for more cash value accumulation and potentially higher non-guaranteed death benefit later on, then that's the direction you go in. But if it absolutely has to be guaranteed from day one and cannot deviate outside of the guaranteed category throughout the lifetime that you're going to own this policy, then regular whole life insurance is your option.
Right.
Okay. That's the list.
That's the list.
Thank you for sticking around for some extra minutes. And I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.